best practice. As we make these advances, the environment around us is also becoming more complex, with stakeholders, regulators requiring more from us. And risks are evolving, measurement methodologies are becoming even more demanding for us in the banking sectors. And I would say both regulators and institutions are now expected to produce, accurate, timely, and even data-driven insights. So in this environment, automation and smarter analytics are no longer an option to us. We would have to really adopt this. And later on, we will be talking about some of the solutions that we are seeing out there that we are leveraging on. And all these are essential to ensure that we are compliant, we are efficient, and we are effective. So as we come here today, this session brings together experts and practitioners to help us reflect on the journey so far with ICAAP. We share our success factors. We can share the roadblocks that we are seeing that institutions continue to face. And more importantly, we discuss, practical solutions, innovations that will help us as participants, our clients and the wider industry to navigate these regulatory frontiers with efficiency and with effectiveness. So again, just to thank you all, our participants from the financial sector and industry partners for joining us today. And I appreciate that the KPMG team for organizing this timely discussion. I will now invite you to engage, share our experiences, explore how we can collectively strengthen the capital and liquidity resilience in our financial systems together. On this, we've lined up a number of experts. We've got a number of partners from KPMG here in East Africa who are joining on this call. But beyond that, we've got other experts. We've got Daniel Thogo, who will be speaking to us shortly, and around ICAAP and ILAAP. And Daniel has extensive experience in this area, having worked for about a decade for a regulator here in Kenya, as well as one of the leading banks within the region. And he will be sharing his experiences on this topic. And we'll also have later on Amitava, who is a partner also in KPMG. He's based in India, but also serves us across Africa. He'll also be sharing his experience and as well as some of the solutions that we are seeing out there to help us on this topic. So without further ado, allow me to welcome my namesake, Daniel Thogo, to speak to us about ICAAP and ILAAP and what we are seeing across the region. So over to you, Thogo.
Thank you very much, Daniel, for that kind of introduction. And good morning, everyone who is on call today. Daniel, you can confirm whether you can hear me from your end.
Loud and clear.
Thank you very much. This is a very interesting topic for me, passionate about because of my experience and the fact that I've seen the institution, especially from the Kenyan jurisdiction, how they have been able to grow over the last close to a decade, since 2016, since we adopted ICAAP. It has been a journey that I have been able to get involved in terms of how the regulator has been able to grow, in terms of what the regulator has expected institutions to do, and as well from being in the practitioner side. What are the kind of the challenges? What are the kind of the critical success factors? And then what then can we be able to do to be able to navigate around those kind of challenges, even as we keep on growing into various markets and the key risks keep on changing. So I'll allow the next slide so that at least you can be able to look at what is the ICAAP overview. And I know in this particular call, we have people from the East African region, where you find that we are at different stages of application of the Basel 2 and Basel 3. but there are also countries that are transitioning from Basel I. So in this particular slide that is before you, is that we are looking at the 3 pillars of Basel II and Basel III. And these pillars actually form together the core foundation of the modern prudential guideline. And I know these ones, they keep on, challenging people in terms of knowing which pillar is which, is that simply pillar 1, it means that this is what the regulator has defined and has guided that in all the application and the understanding of this particular risk and the management, is that under pillar 1, the regulator has guided that these 3 risks, that is a credit risk, that is a market risk, and the operational risk, the regulator has given the guidance in terms of the approach and then how capital are charged for those particular risks should be computed. And as you can see there, the regulator has proposed some of the methodologies and the approaches that you can be able to use as you're computing capital charge for this. In terms of the standardized approach for credit and market, and even the basic indicator approach. But in today's discussion, we will not discuss about pillar 1. Most of the participants in this particular forum, you're already good at that. You have been able to submit these regulatory returns to the regulator, even to the board, for quite a number of years. But our point of discussion today here is on pillar 2. And this is where the consideration is that other than the 3 risks that have been mentioned, the regulator invites the institution now to say, what other risks are you exposed to? And those are what we call pillar 2 risks. And these pillar 2 risks, they are very many, depending on the kind of the business model as an institution you are running. You're talking about reputational risk, talking about strategy risk, you're talking about other risks to do with cybersecurity, other risks that have not been covered well under pillar 1, like concentration risk, so many of them. And in this particular discussion, we'll be finding out, as we have continued to grow in the industry, what are some of the challenges and what are the kind of the learning points? And even how can we even be more better to navigate those kind of challenges, even as we keep on growing. The next slide, please. So in this particular slide, we are just simply trying to refresh what you have been doing for the last 10 years. And you're looking what is the general overview of an ICAAP. And as you can see from the left side, we are having all the risks that we have identified. And this particular risk, when we have identified them, of critical importance here, we want to mention is that we identify these particular risks and we document them through the enterprise risk management framework. And once we do that, we are able to find and even document what is the risk appetite, both qualitatively and quantitatively. And I keep on, and I can see some of the people here in this call, they are auditors. And it's very funny that when they are reviewing the enterprise risk management framework, the risk people in this forum, they say that we have zero appetite. Let's say, for example, for reputational risk. How then do you stress zero appetite? That is qualitative. How then do you go ahead and even quantify that? So those are the kind of the conversation that we'll be having, and even the kind of the challenges that institutions have been able to face, and even how the kind of the feedback we have got from our clients from the industry. And then once we identify this particular risk and we define what is the risk appetite, then they feed into the economic capital. And I can see that we have 2 capital there. We have economic capital, and this represents the bank's internal estimate of the capital actually required to cover all the material risks. But alongside that, we have the available capital. What do we have today? What is the baseline capital? And then once we stress that, we're able to evaluate, then what are the capital ratios? Are we meeting those particular ratios? If you can see from that particular slide, 3 things. On the top there, we are having strategy and business planning. In the middle there, we are having stress testing of those particular capital I have talked about. And there down, we are having the risk measurement and management processes. So this is the ecosystem that you're talking about. How then are you able to do your capital planning, stress, do the scenario designs to be able to ensure that you are able to update your risk management processes, and you are able at least to be able to ensure that the strategy and the business and the capital planning, they are in line. And therefore, as you are going to be finding out, that ICAAP becomes a very critical document. It becomes a very critical document for the board to be able to draw insight, even as they are doing the strategy of the institution. But as you're going to be finding out is that, and most of you will be able to confess that some of us, we treat the ICAAP document as a regulatory document, as a tick box. But then how then can we be able to derive how can we then be able to derive the strategic insight and the value of an ICAAP process? The next slide, please. So what then do regulators here and even in the East African region, what do they require when we are preparing the ICAAP document? And at the heart of it is that we are having at the center of that particular picture the fact that we are having the various components. And those particular components, we are saying that there is the oversight, there is those people who are responsible for oversight, there are those people who are responsible for stress testing. And as you're seated in this particular platform, you know where you lie, because I know here we are having practitioners. There are people who are in charge of the compliance reporting, those people who report and submit this particular document to the regulator. There are those people in terms of the people in learning the strategy. How then do they use this particular ICAAP document to be able to ensure that they inform the strategy of the institution? And as I rush through this, and as I go to finish, we will talk about the kind of the challenges. And I'm taking you through this particular journey so that we find out that some of the key important components here is that institutions are doing very well in terms of the governance, in terms of who is responsible. That is very much okay. In terms of having the stress testing policy, those are okay. But in terms of the material assessment of these particular risks, in terms of ensuring that how then do we able to ensure that we stress and we do the scenario designs is a challenge that we have noted in the industry, and I'll be able to indicate how then that has come out to be. But then the most important thing is that during the ICAAP process, that is usually done possibly before the end of the year so that it can be submitted to the regulator in the next year. It is a process to some that it is stressful, because when you're talking about stress testing and you're telling me that, let me stress reputational risk, how do I stress reputational risk? How do I come with an ICAAP number in that particular context? So we will be seeing then, how do we then able to meet this regulatory expectation from the ICAAP? Next slide, please. Thank you. And through the best practice, and for those people who are now transitioning from Basel 1 to Basel 2, there is a standardized aspect of what then are the key ingredients of an ICAAP report. Of course, there is an executive summary. This is where you're highlighting all what is your methodology, what are your findings, and what are the overall capital adequacy position. Those three things in terms of what are the methodologies that you have used, and what are the findings that you're making from those particular from that particular methodology, and what is the overall capital position? Is it adequate, and do you need to mobilize more capital? So if you're looking at the background of that particular report, and I know this is something that most of you are very familiar with, is that you're looking at how then do you set the context in that particular report so that even people who are not members of the institution, they can be able to read and understand where you're coming from in terms of your capital planning. You're looking at what is your business model, what is the balance sheet structure, and what is the strategic plan that you have as an institution. And the reason I'm mentioning the model, the operating model, the balance sheet structure, and even the capital, the strategic plan, is because all of them, they fit into your capital needs. And then the material risk assessment is at the heart of ICAAP. And I would want to emphasize this. How then do you do your risk assessment? How do you map out all the key risks, and how do you align them to the risk profile and the appetite of your institution? For example here, how then do you align that? The board has said that our risk appetite is that our NPLs at any point in time cannot exceed more than 10%. How then do you align that and ensure that your methodology explains this and you're able to quantify and translate those particular requirements into capital requirements? Then the stress testing, how then do you able to do the adverse scenarios and do the stress testing and even do the reporting? The next slide, please. I have been able to go through this in the previous slides, and this is where at least we are just trying to indicate what is the ICAAP process flow in terms of the organizational structure, in terms of what is our strategy and what is our appetite, how then do we identify those particular risks, how then do we quantify them, how then we do capital planning and forecasting. And this is something that at least you're going to demonstrate in terms of how then has it been a challenge, and then how do we even navigate that. And then we are having, of course, the risk measurement and performance. This is where we are saying that we are linking capital limits and allocation of those particular capital that we have defined per every risk to strategic planning, to individual business units, and even to pricing decisions. And as you can be able to understand that CBK right now has been on the forefront in terms of trying to enable institutions, how then do they price even their loans? Right now we are talking about, we are moving from the RBCP model to the Tesonia framework. And then of course, the ICAAP reporting. So in essence, you're saying that it's an ongoing control and a validation. And we ensure that ICAAP remains a dynamic process that links governance, risk appetite, and strategic decision making. Let's go to the next slide, please. So as I wrap up on ICAAP, and for me, these are witnessed firsthand, where you engage with the institution on what the ICAAP process has been for the last 10 years. And one of it is that there's very weak integration between ICAAP, the ERMF, and the strategic planning. You'll find that in this particular challenge, institutions, many banks, it remains a regulatory exercise that they want to tick the boxes rather than a tool that can actively drive business strategy and capital decisions. So you find that the board has adopted the ERMF, the strategy is there, but then if the document that is supposed to advise what capital you need is not done properly, then it doesn't enable the institution to be able to drive value from it. So how then do we use ICAAP to be able to ensure that how we have evaluated ourselves and the capital adequacy we have is able to enable us to go ahead and actually even provide more insight to the board. And this actually can be attested that how many board members actually even know about the ICAAP and actually what value do they derive from it, and even how do they use ICAAP to be able to do their decision making in terms of where the strategy of the institution goes. The next one and the second challenge is that we see a lot of inconsistent methodologies and poorly designed stress testing scenarios. And you find here that the assumptions that have been taken in the design of the stress testing and the ICAAP is very different, because you'll find that, like the example I gave, that we have said that the board doesn't have any more appetite to have NPLs exceeding 30. But you may find that in the baseline scenario, somebody making a decision to maybe use a scenario of maybe 30% as NPLs, as an NPL status, then how then do we align all this? So you find that ICAAP becomes siloed, it becomes a disjointed exercise where things are not speaking and they're not linked back to key risk drivers of those particular risks, and even possibly the risk appetite. And then the third one we find is that, and this is very interesting, is in terms of the capacity and the ownership gaps, where you find that when you're doing the ICAAP process, the head of finance, or maybe the people in finance who end up driving the ICAAP process, they say that you are the head of consumer experience, and please go and come up with an ICAAP number. So you're telling somebody who has not computed anything, you're telling them, and they ask you, how do I compute? You're telling them, go and use the HHI index as a methodology. Simply, these people, they run away, or they just come, from thin air, they give you a number, you put it in ICAAP, and then the kind of the experience it have is that people are not interested in this exercise. People find it, it's a very painful exercise. But then how do we solve this one? And as you're finding is that the last one is the people dependency. This ICAAP process is so dependent on the stress testing, and sometimes you find that if, like, for example, the person who's doing the stress testing in an institution leaves, the ICAAP process collapses. But then how can we be able to learn? And how can we be able to say that the feedback that we have been able to get from our clients, how then do we navigate all these particular issues? I want you to hold on that particular thought then. If these are the challenges, then how do we navigate them? Hold on to that, and then I take you to a different area that is similar to the discussion we are having today. And this is ILAAP, meaning internal liquidity adequacy assessment process. What is it? And even what similarity does it draw from the ICAAP process? And what lessons have we been able to learn as we have been able to employ our tactics, our intelligence, the guidance we have got from the regulator to come so far under ICAAP, and how then can we be able to deploy the same under ILAAP? And as you go to the next step is that, the next slide, please. You're finding that it follows and it mirrors the same approach. And this is purely under Basel III. And you're saying that under Pillar 1, this is where you say that the regulators at any point in time, in Pillar 1, they give the computation, they give the formulas, and they tell you this is the return that you'll make to us, and this is the computation that you'll make and submit to us. That has happened. And as you're speaking today, is that we are 7 days old into this. CBK was able to issue this particular guideline. And we are saying that this is a grounding and this is a preparation of how now to move to Pillar 2. And Pillar 2 now says, this is how now you're going to be managing this particular liquidity. This is the kind of the scenarios that you're going to be evaluating on your own and being able to now come and convince us that indeed you are satisfied with the processes that you have undertaken yourself. And of course, you go to Pillar 3. This is in terms of the transparency and the disclosure. If you go into the next step, is that the next slide, is that in the East African region, the regulator, like what Dan mentioned in his introductory remarks, is that the other particular region, our neighbors here in Uganda and Tanzania, very far much ahead. And actually this year, we were able to have the inaugural reports in Uganda. And these are some of the journey we have been able to work with some of our clients within the region. And are there challenges? And what are the best practices? And I would want to stop there to give back to you, Daniel, so that you can invite the other speaker to be able to mention one or two things. What is the best practice in the industry? What are the kind of the learning lessons? Then perhaps you can be able to draw from there. And then as we're able to be looking into those particular two areas, the ICAAP and ILAAP, then we ask ourselves, what then and how do we navigate around those particular areas, from the challenges that we are facing to the solutions that we seek, possibly to run our institutions effectively and efficiently to improve their resilience in terms of capital and liquidity. Back to you, Daniel.
Thank you very much, Thogo, for that good session. I think for the purposes of those who have joined us late, Daniel Thogo is a manager within KPMG in East Africa, within the financial risk management department. I'm told I forgot to introduce myself. My name is Daniel Karuga. I'm partner and head of enterprise risk services within East Africa. So Daniel has taken us through the overview of both ICAAP and ILAAP. And he's mentioned quite a number of things, especially how can we use these two tools more strategically so that they are helpful to us, not just as a compliance tool, but so that they're also helping us as a business. I'm just checking, just encouraging all of us, if you have any question, feel free to type it on the chat, and our panelists will be answering this as we move along. Just also to recognize a number of our partners who have joined on this call. I did mention Amitava, who will be coming up shortly, but there's other partners. We've got Bernard Amuka, who is our head of business consulting services. You can see Muthusi Mackenzie, who is a partner in our deal and strategy team. I can see Alex Mbai, again, our head of clients and markets. So I have a big panel. So should you have any questions, post them, and we'll continue to answer them. At this point, allow me to invite Amitava to be able to take us through the next session. Most welcome, Amitava.
All right. Thank you, Daniel. So I'll continue with the discussion which Daniel had left with in terms of ILAAP. If we go to so as Daniel mentioned, some of the core components of ILAAP is certain ratios which the regulator expects you to calculate. Basically, the liquidity coverage ratio, where they want to ensure that you have enough liquidity for the first 30 days. And, all these ratios, if you see, these have come in as a Basel III regulations. These were not originally part of Basel II regulation. And after Basel II regulation, there were certain financial crises which had happened, and hence there were learnings from those crises. And as a part of those learning crises, multiple measures were mentioned First was the liquidity crisis. So there will be the LCR and NSFR got created. Then there are a lot of banks who had a huge amount of borrowings, and they were not able to meet those debt obligations because the amount of exposures or assets were much more than the liabilities. So in those cases, the leverage ratio came into place. Then we had the certain capital buffers, the counter cyclical buffer, and those buffers got introduced. So, every time the regulator comes out with some sort of proactive measures, good practices which banks needs to adopt, and then there may be some other new crisis origination which may happen, which becomes a learning, and then those practices are advanced. So LCR was one of those new ratios which got introduced. Basically, it's ensuring less than 30 days you have enough liquidity available for meeting your obligations. We will demonstrate to you on the automated platform, so I'm not taking much time in this slide currently. Moving to the next slide, the NSFR ratio basically ensures that over a long period of time, beyond 30 days, beyond 1 year, how much amount of liquidity you are maintaining. Again, there are certain good practices around how to maintain NSFR ratios and how to ensure that you are churning your assets and liabilities so that you are able to manage your NSFR as well as LCR ratio. Next slide, please. And then in addition to that, what we have seen as best practice, a lot of other jurisdictions are using multiple other ratios. For example, liquid assets to short-term liabilities. This is a very important ratio to understand how much of your assets in the short term is liquid vis-a-vis to your liabilities. What are your volatile liabilities to total assets? So they have defined what do you mean by volatile liabilities. What are the core deposits to assets? So again, there is a definition as to what is core deposit. So there are multiple ratios, what we have seen in multiple jurisdictions. So what we have done is, based on our learning from various banks and countries, we have incorporated everything into the automated platform, which we are going to demonstrate to you in some point of time. Next slide, please. Yeah, so this is a liquidity stress testing framework, which Daniel had mentioned multiple times in his speech, that stress testing plays a very important role in ICAAP. It plays a very important role in capital management because typically, all the economic cycles go through ups and downs. It is important that whenever the cycle is on the up movement, whenever all the things looks very good, at that point of time, you definitely need to prepare that what in case any events happen, how will I get impacted? So stress testing essentially helps you create various scenarios. Some of these scenarios can be hypothetical scenarios in the sense that it has never happened, but may happen, and second can be the actual scenarios, the historical scenarios, like a COVID crisis. If it happens today, how will my bank get impacted? If there's a financial crisis which happens today, how is my bank impacted? And we have seen of late that all the jurisdictions, countries are linked to each other, and hence we have seen contagion risk much more than what we have seen 10 years back. A lot of countries in Africa, because of their imports and exports, they're all linked to multiple countries. So any impact on any other country, it has a contagion effect on the East African countries. So it's important to understand how I identify those contagion effect. How do I ensure that my macroeconomic parameters are being considered in stress testing? How am I ensuring that any sort of idiosyncratic risk are also considered in my stress testing to ensure that you are having a very strong framework around stress testing. At this point of time, I just want to quickly cover one important aspects, that when I say liquidity risk, as Daniel was mentioning, that it is just not a tick in the box. ICAAP and ILAAP plays a very critical role in overall resiliency of the economy as well as the bank. Now, what we have seen typically that why liquidity ratio or why liquidity governance is very critical for our East African markets. First and foremost, we have seen that the operational cost in East African markets are much more than your global averages. Typically, global average we have seen around 2.2% of total assets. However, in East Africa, most of the countries have 4.2% as operational cost against total assets. So cost is on the higher side in East African financial system. The second part, which is very important, is that the banking penetration in Africa is much, much lesser. That means that we are more dependent on a small depositor base, and it's not a very large diversified depositors base. So hence it becomes critical. How do we manage our deposits? How do we are able to garner deposits? What is core deposit? Which deposit is volatile? So having a very strong understanding of volatile deposits versus core deposits plays a very important role in my overall liquidity risk governance system. The third part is in terms of credit risk. We have seen that the typical NPL percentages are higher, especially for microfinance industries where it is the highest. Hence, it is important that we understand what type of defaults had happened and may happen in the future, so that we are able to consider everything in our liquidity stress testing modules. Similarly, we have seen that there are large concentration of banks in these markets. So in 2025, largest banks in the African countries control around 70% of the market share. So that means that the other banks hardly have 30% of the market share. So it becomes a very highly concentrated banking practice. So this plays a very important role. And then the last point which I want to also focus is banks have a very limited access to long-term funding. Banks face a lot of challenges in obtaining or raising long-term funds, and which typically leads to maturity mismatches in the ALM bucket. So it's important that you understand all these concepts and realize that the requirement of ILAP and ICAAP is much more strategic, long-term in nature rather than just a regulatory compliance. So these are some elements I want to leave upon for now. Of course, there are multiple. We will be responding to all your questions in some point of time. But in the interest of time, I just want to quickly take you through the solution too, so that you are able to understand in terms of how these types of platforms can help you increase your overall governance process, and it can reduce your compliance cost and ensure also that all the best practices are being adopted for your particular bank. So I'll share my screen. If one of you can confirm, you can see. Yes, Daniel, any one of you can, if you can confirm, you can see my screen.
Yes, I can see your screen.
Excellent. Thank you. Thank you. So typically, as we discussed yesterday, the best part of these solutions are, 5 key important things. One, it's a web-based solution. So there's no problem in terms of installation, implementation, having in different desktop. Those things are all eroded. Any employee within the bank who have access to, Chrome browser or Internet Explorer browser, anybody can just log into that particular system using your own Windows single sign-on password. So that's as easy as that. Second is the solution is very light. So that means that you don't have to spend any additional dollar in infrastructure, in database, in server, all these solutions which are provided by vendors, not only have to purchase that, you have to invest in additional hardware configurations. But this solution does not require anything. It is very light-hearted, and it will be installed within the bank. KPMG will not have access to the data, so your entire data confidentiality is ensured. The third is it's a workflow-based solution. That means that there's an audit trail for every changes which are done in the system. It is auditable, and it has got a workflow system. There's a maker checker defined into it, and there is a user access management is provided. And then, you can always provide different users, different types of accesses so that they can run the solution based on their job roles. The fourth part, which is also a very strong point of the solution, is that it has got unlimited license. So there is no dependency that you are for 5 licenses you have to pay a certain amount, and for 10 licenses you have to pay double. There's nothing like that. It's a very simple, short-term commercially less heavy is the cost of the solution. And sitting at your office, you can give unlimited number of users, unlimited number of rights from the front end of the system. So that is one of the key strong points of the solution. So I'll quickly take you through the solution now in terms of how does it work and some of the core modules of the solution. Since it is developed internally by KPMG, the entire solution can be automated and can be customized. So and it is not compulsory that you have to buy all the modules. Whichever ones you believe is relevant for the bank, we can just pick it out and give it to you. And we will customize it based on what your internal governance process of the bank is. So this is a one version which I'm showing it to, for which we have implemented for a very large bank. On the left hand side are the key modules or functionalities of the system. First and foremost is a dashboard, which is more like a management dashboard, where all different types of trend analysis, financial reporting numbers, everything can be culled together. And these dashboards are customizable. We can have different dashboards for the CRO, for the CFO, for the CEO. We can have for different departments. We can have for different subject matter also. Then we have a data module. Basically, the data module is where you have to upload all the data. Now, this works in two ways. One is we have given an option where you can upload the data into an Excel file or a CSV file and then upload it into the system. Vis-a-vis some of the large banks where we have done the implementation, they have asked for automated integration with their core banking solution and treasury systems. So using APIs, we have linked this to the other source systems. Data comes from those source system in batch processing runs. It gets automated comes into the system. The system processes the data, highlights the data quality issues. Once the data qualities are removed, it is embedded within the system, and all the calculations happen automatically at the back end of the system. Of course, the system will come with a very detailed manual so that anybody who wants to go through the manual and understand how the system works, everything is created in the system. Then on the left-hand side, would like to point out what Daniel mentioned. Material identification of material risk becomes an important role. This is a framework which we have created because multiple global foreign banks are using it. Again, this is just a framework which we are suggesting. Not necessarily you have to adopt this. If you have any other framework for identifying materiality, happy to automate that so that it becomes relevant for you. Once we identify which risk are material, for all the material risk, I will then go to the next step, which is identification of risk appetite. So here we will create which are the material risks, and for these material risks, what is the appetite which I have defined for my bank, so that this gets monitored on a continuous basis. The next part plays a very critical role in my overall business. What we have seen in many banks is that the business strategy or the business document is independent of risk management document, but this is completely irrelevant in the current business. In the current state of being, you should have enough amount of capital to support your business, to fund your business. The business team cannot create an independent set of business strategy which does not have any correlation or any consideration of Basel capital. So what the solution basically does is it ensures that your risk management processes are married with your business strategy. In case you are creating certain business strategy which says that, look, I will not have enough capital to fund it, the solution will give you that gap. Why? So that when the CFO gets to know that, okay, fine, this is how if I want to grow and this is where I'm falling short of capital, the CFO can raise that additional capital. Or the CFO can go back to the bank CEO and say that, hey, I cannot grow in that way because capital will become a constraint. So I need to understand that for funding a particular business plan, for having 5%, 10%, 50% growth rate for the next 3 years, will I be having enough regulatory capital to support my business? So that's what the business plan module is providing. Then we come to risk quantification. Basically, this will cover your pillar 1 and pillar 2 risk. This solution has pillar 2 risk. Pillar 1 risk is more of an input to the solution. Of course, we can automate the pillar 1 risk, but because a lot of banks have already done it, we didn't want to duplicate that effort. So pillar 1 risk is basically an input from your other systems into the system, but The pillar 2 risk is what is getting computed within this particular platform. So we have all the different parts of pillar 2 risk created out here based on what we have seen as the most relevant methodologies for all of you. For example, we can help you calculate interest rate risk in banking book. Then we help you calculate concentration risk, liquidity risk, leverage ratio, strategic risk, reputational risk, model risk, residual risk, blah, blah. So all different types of risk we have already identified, and I'll take you through some of these methodologies. But again, these systems are completely customizable. If you have any other methodologies, we can automate that too. So once we have done all my risk quantification under normal scenario, I will go to my next scenario, which is your stress testing. Under stress testing, you can do a historical stress testing or a scenario analysis, and you can see that in case any of these stress events happen, how will my capital will get impacted, both my tier 1 and tier 2 capital, how will they get impacted, and whether I will be falling short of capital at any point of time, and accordingly you can then take a corrective measures. So that's the next one. The last part is around RAROC. Basically what we need to understand that which product, which account, which region, which branch, which relationship manager is contributing maximum to my profitability. So RAROC is a measure, it's more of a risk adjusted return on capital. It will essentially tell you that what type of returns we are generating at a most granular level, so that you understand which area you need to allocate capital more to make your banks more profitable. Simple questions to a CEO like, is your wholesale banking more profitable or retail banking? Is your within your retail banking, is it your secured loans more profitable or unsecured loans? Within unsecured loans, is the personal loan portfolio more profitable or credit cards? Within credit cards, is the HNI segment more profitable or mass segment? So it goes into each and every account details of your customer. So the calculation happens at the most granular level, and then that aggregates at an enterprise level so that all the business team can take a right decision in terms of what is contributing to my profitability and what is not. And whichever is contributing to my profitability, I will tend to allocate capital more in those segments because my capital is scarce, my capital is limited. I don't have so much capital to play around with. So this will essentially help me to identify my profitability measures and then what is my capital management. And the last part is the reporting part, any sort of disclosures, financial reporting, investors reporting, whichever you want to do, everything, all the templates have been created. Since you are running all these calculations, since you are inputting the data, all these reports will get created automatically. You can download the report and then you can share it with your investors and employees. So that's the overall flow of the ICAAP solution. Now I will go into the little details of each and every solution to give you a quick glance of how the solution looks like. So again, we come back to the first point, which is your dashboard. In dashboard, we have created multiple versions. So there's a risk appetite solution where you can see how the risk appetite has moved over a period of time. What is a loan to deposit ratio? What is a RAROC? What is your capital adequacy ratio? So last 3 years, 5 years, all these dashboards will get created or populated automatically. Then we come to your regulatory capital. Again, you can see that how your regulatory capital has been increasing or decreasing, what type of corrective action you need to take. So you can take a decision from here. More importantly, it will also tell you what type of capital shortfall or surplus which you will be having and at which point of time. So this is all futuristic so that you can take corrective actions in your business as well as in raising additional capital. Then we come to the economic capital. Again, in terms of if you are using IRB approach or FIRB approach, you can do those types of calculations also into the system. So both in terms of graphical presentation or tabular presentation, everything has been done out here. And lastly, while all these things are provided in a normal scenario, you also need to understand under stress scenario. Like you can apply various stress and then you can calculate what type of capital requirements you will have in the future. I'll cover the stress testing module also in details, but this is just the high level presentation of your the dashboarding part, visualization of your stress testing. Then I come to the second module on the left-hand side, which is your data. We have created multiple templates based on what the system will require. We will talk to your IT team. We will understand what is the source of data, what is the genesis, which source system from which the data will come. The system can do the data aggregation and it can do the consolidation, and based on that, the calculations will happen. So this is a field which we will discuss with your IT team, and we will see how we can automate it, or in case the IT team prefers more of an upload the data, that is also possible. Then we come to the next, so the data quality checks. Once the data is inside, it will do all the different types of data quality checks, like are there any negative values, if there are any outliers, if there are any missing values, if there are any duplicates. So all those checks will be highlighted so that you can make the corrections, and only the right set of data is now ingested within the system for calculation. Then we come to the third module, which is a materiality. So materiality assessment essentially tells you which are the risks which are material for you. For example, credit risk, market risk, operational risk, liquidity risk. These are the basic areas where all banks consider as to be material. Plus, you have this concentration risk, interest rate risk in banking book, reputation. So all these things are considered material. So you can understand currently where your risk is currently lying and what is your historical numbers vis-a-vis it has been increasing or it has been improving. You can also do a new sort of assessment. Basically, you can click on new assessment where the entire risk tree is created in front of you. For example, people risk. This particular bank where we have done the implementation, they don't consider people risk as a sort of important, or it's been considered under the operational risk. Hence, they have not separately calculated people risk. But different banks have got different views in doing so. So this is one of the large global banks is what the framework is following. They first try to identify what are the significant activities within the bank. Based on significant activities, they identify what can be the impact if any of these activities have gone down. Based on that, they identify the underlying risk factors, and based on that risk factors, they finally arrive at material risk. So which are the ones which are material and which are the ones which are non-material. So this is a sort of both quantitative and qualitative assessment to identify what is materiality. But end of the day, it's some sort of framework, a scientific way of approaching into a materiality of risk. Once we identified which risk are material, it flows to the next module, which is your risk appetite. In your risk appetite, you then identify, okay, credit risk is material. For credit risk, I think gross non-performing loans is important. Provision coverage ratio is important. Staging, movement of exposures from group 2 to group 3 or stage 2 to stage 3 is important. So like this, they have identified different types of risk appetite which they want to define for all the material risk, which includes your credit risk, liquidity risk, concentration risk, and going forward. And then you can also see what are the historical comparison. For example, in this case, my earlier gross non-performing loan was better, which was under green, but now it has gone to red, which is not a very good sign for me. So things like that. So that's a comparison. And then you can also see the risk appetite statement, where the entire risk appetite has been defined. So again, when we do these automations, when we do these transformation work, we advise to our clients what other banks are doing, what is the best practice, what is relevant for your particular bank, and accordingly we make those enhancements in our risk appetite statement. So here you can see for one of the examples of a risk appetite statement, there are both quantitative as well as qualitative criterias. We have identified what are the matrices, how the assessment will be done for that particular matrix, what is the current risk number, so what is the risk profile, and whether it is in the green, red, or yellow zone. And in case any of these are in the red zone or green zone, by click of a button, you can send an email to the stakeholder saying that, hey, my total capital ratio under stress condition is currently red, which is not a good sign. We need to take corrective action so that next time when I report my risk appetite, it is in a better condition. So that's the first part of the risk appetite. Of course, you can see the details of your thresholds. You can always configure those changes in the system itself from the front end. There is no dependency on us, and you can also download these risk appetite into an Excel sheet for your views. And of course, you can make some changes in your risk appetite also. So, for example, just an example as to how the red, amber, green is getting computed. Basically, for one matrix example, let's take the first one, the quantitative metrics. Basically, we are seeing tier one capital ratio, which we are monitoring on a quarterly basis. It is a manual input into the system. It's more of a ratio which we are calculating, and then we have defined these three threshold pillars, right? So if it is more than 12%, it is in a comfortable zone. If it is 9 to 12%, it is in a warning zone, and if it is less than 9%, it is a red zone or a critical zone. So the color calculation happens based on this. Again, these numbers are configurable. You can change it yourself, and you can then monitor it accordingly. Now, this is how the entire risk appetite module works. Then we go to this next part, which is your business planning and assumptions. As I mentioned, basically what it does is it tries to integrate your risk management with your business strategy and business planning, so that the business managers get a fair view that whether they will have adequate capital to fund their very aggressive growth rate, which they are thinking. So because capital will be one of the constraining factors for business growth. So how does this entire thing work? Basically, it asks you to share some insights in terms of your business growth rate. For example, outstanding growth rate for the next 3 years. So assume that today we are in 2021. It is asking for 2021 is when we had implemented this solution. So it is a little backdated. For 2022, 23, and 24, how your debt will grow over a period of time. Similarly, how your receivables, how your other assets. So it will ask you for some numbers as to how you want to grow. And based on this, it will simulate your balance sheet. Similarly, for P&L ratio, so whatever are your debit items and credit items in your profit and loss statement, everything will be included out here, and then finally your simulations will happen. So what is a simulated balance sheet? Based on the inputs which you have given, which is applied in your existing numbers, you can see what are your assets and what are your liabilities looking like in the future. And then it will also tell you whether you will have enough amount of capital to fund these particular assets and liabilities. Similarly, for your P&L statement, based on your growth rate and targets, it will tell you what are the types of incomes and expenses which will happen and what will be your profit after tax. So basically, it will help you to create those various scenarios and to tell or give comfort to the CEO that yes, the business growth rate which we are projecting is practical because the risk management standards are also integrated into my business growth rate. Then I come to the risk quantification part. As I mentioned in pillar one risk, basically these are all inputs. We have a separate system which can do calculation of standardized approach and IRB approaches. But this system is basically taking inputs from your other systems so that you can do the calculation. But more importantly, what this system essentially allows is doing calculation of your pillar two risk. So whenever we come to pillar two risk, let's take the first one. Your interest rate risk in banking book. We have been seeing that, the interest rates have become very volatile. They are currently coming down. There are a lot of issues which we are facing. And hence, managing your interest rate risk in banking book plays a very important role. So how the system works for all the risk, basically you upload the relevant data from your asset liability management system. And based on that, it will do your bucketing based on what the regulatory requirements are, like what is your overnight inflows and outflows, or what are the inflows and outflows from 1 day to 1 month, 1 month to 3 months, 3 months to 6 months. You can do it in various currencies also, because I understand a lot of your bank institutions have multiple subsidiaries in different countries. So you can do it at a different currency level, and you can also integrate it, consolidate it at your base currency level. So all your assets and liabilities are currently mapped out here. Then you can include those scenarios, like what type of shocks you want to apply, like you want to move your entire interest rate cost by 120 bips, or you just want to change for the short term around 170 bips, long term for 100 bips. Different types of options you can select. And based on these selections, it will apply on your maturity schedule, your assets and liabilities, the previous statement which I showed you. And based on that, see, these are the shocks which I'm applying. For example, this is a 120 bips shock which I'm applying across all the buckets. You can change that. You can apply 120 in the initial four bucket and 170 in the next four buckets based on your expectation as to how the interest will keep on moving in the distant future. And once you apply the shocks, basically it will calculate your EVE. So you can select which one you want to apply. For example, I select the first one, and for first one you apply this shock, and you'll see what is the impact on your EVE. So that's an important parameter which you want to see, and then based on that you can then take your corrective action. Right. So this is what my IRRBB looks like. Then we have concentration risk. Daniel did allude that we are basically helping to calculate HHI. So all the HHI for your prop book, for your loan book, group counterparty exposure, single counterparty exposure, everything gets calculated out here. And then you can see your concentration for any particular group borrower or single counterparty borrower. Then we come to, liquidity risk. So basically your LCR gets calculated out here. So whatever template format which has been given by a regulator, everything will be automated out here. The runoff factors are also included out here. You just need to include your exposures, and the calculation will happen. And finally, you'll get to know how much your LCR ratio is. So that's your LCR. Similarly, you have another module for your NSFR calculation, where you just input the data for which period you want to do the calculations. The risk factors are all hard coded. Just the amount will only have to be included or changed. So it will either come from your source systems, or some calculations will also happen at the back end of this system. So your NSFR calculations will happen, and then finally you see what is your NSFR ratio. Then we come to the leverage ratio, which is also an important part. So this is how the leverage ratio will get calculated. So all the templates, formulas are all inputted into the system. You just have to provide the relevant inputs, and you can then calculate your various ratios. Then we come to the other risk, which is like the strategic risk or reputational risk. What we have done is, although these are very qualitative in nature, we have tried to quantify them as to nearest to the possible, so that any sort of subjectivity is removed, and there's a very institutionalized way of calculating my strategic risk and reputational risk. So essentially, what happens is, different banks. The risk management should not work in silo. It shouldn't be that the reputational risk is completely assessed by the risk team and nobody in the bank actually knows about it, which is not the right thing, because the reputational risk can come from each and every employee, function, process, system of the bank, right? So that's why what we have done is, by way of a workflow, we have identified who are the various stakeholders who will have to provide an input of their assessment into these factors, and then the system will consolidate all the assessment factors, and then we'll give you a final score. For example, what are the different types of strategy definitions which have been identified? What do you mean by low? What do you mean by medium? And what do you mean by high? Similarly, what type of competitive assessment have been done, what is a position in the market as a peer group, increase or decrease of market share. So different types of strategic initiatives which the bank wants to take. We have created a scorecard, and finally a scorecard will give you a final score, and there's a template or they retain any capital. However, if the score is between 25 to 50, we need to maintain additional amount of capital. So similarly, we have done it for reputational risk, which is more like a sort of scorecard, which we have done. But again, the assessment has to be done by various stakeholders within the bank. So here we are trying to see what are the ways your reputation can be impacted. Who are the stakeholders who determine your reputation? For example, first is regulatory. what type of fines, penalties they have charged to you, how does the regulator look into you. Then we have media, like what is the perception of media about your particular bank. Then we have for employees, how does internal employees consider the current organization. Then the investors and the overall. So there are a lot of stakeholders which are involved. We have tried to make it as quantifiable as possible. And then based on these matrices, the various stakeholders will provide their inputs. The system will consolidate all the inputs and then finally give you a final answer. Blah blah. So there are a lot of, in the interest of time, I'll just quickly, cover all these things. So residual risk, model risk, reputation risk, all these things run. More importantly, we'll come to another important structure, which is your scenario analysis or stress testing. Here you can do individual, so sensitivity analysis for each and every risk, or you can do macroeconomic stress testing, which is basically using your regression approach to ensure that all different macroeconomic factors are considered for understanding what can be the impact. So, for example, in sensitivity analysis, you can do credit quality deterioration. For example, your NPLs are increasing or decreasing over a period of time. All these inputs can be provided into the system. You can make these changes from the front end of the system and the calculation will happen automatically to give you the output. So in case your NPLs increase over a period of time, what in case there's a depletion in your collateral values, what in case NPL increase only for the corporate banking book, what in case NPL increase only for your retail banking book, what happens if the gold prices depreciate over a period of time, what happens in case your interest rates actually change over a period of time, and then what happens if there are any FX shocks. So foreign exchange sudden appreciation or depreciation, everything can be considered to identify what can be the impact. Then we come to macroeconomic stress testing. Again, you have to include the GDP data out here, all the macroeconomic variables you have to upload. And based on various regression analysis, it'll identify which parts of your portfolio will get impacted, and then what will be the impact on your final RWA calculation. So what type of NPL will get created, how will it deplete your RWA capital, and what will be the impact of stress testing on your capital. So here the impact assessment will be done. For example, in this case, you can see under normal scenario, my capital is 1,598 million. However, under stress scenario, which is my credit quality deterioration, my capital is coming down to 1,349. Similarly, all the other things will get calculated and you will get to know what can be the impact of stress testing on my portfolio. Then we come to RAROC. Basically, RAROC does, as I mentioned, for each and every credit facility, it will ask you for your income and expenses as well as your provision. And the denominator, that will be the numerator. The denominator is basically your capital charge, and it will tell you that for your various portfolios, what is contributing to the profitability of the bank and what is not contributing. So entire RAROC has been automated in the system, which you can use it for your capital allocation and management. And then finally, your disclosure requirements. So any sort of financial disclosure requirement which your regulator has mandated, everything will be automated out here. Different types of reports which you have already created, which you can see out here. This is based on one of the bank's regulatory requirement. We have just automated all the reports. I'll just quickly take you through this one. Basically, here you can see that, for the next 3 years, which is your 24, 25, 26, different types of calculations have happened. And as per normal scenario, it's only in 1 year which you will be falling short of capital. So 2024 is where you will fall short of capital, and all the other years you have enough capital to play around with. However, if I do the same calculation with stress testing included, I will see that, in most of the years I've been actually falling short of capital. So that means that, these are the years I need to be concerned of, and any of these stress events happen, then I will get impacted to this extent. So that is it. And of course, you can download these reports into CSV and Excel file for pasting into your internal documents of the bank. And then the entire workflow is there. The email alerts can be created in the system, where any email alerts, which reminders which you want to send out to the stakeholders, that can also be done from the system. And then a lot of different analytical outputs can be created from the back end of the system. Right. I think we'll go back to the presentation slide. I just have one more slide to present. Yeah, so this is just a concluding a summarization of what I showed it to you. The entire governance process is built into the system. The business plan projections, which includes your risk management projections, are also included. All the pillar 2 risk calculations are included into the system. You can create various types of scenario analysis, historical data analysis for your stress testing. There's a dashboards and reports which are completely customizable for your requirement. And then the final capital management in terms of pillar 1, pillar 2, tier 1, tier 2, capital adequacy ratio, everything has been automated into the platform. Yeah, I think that's all. Back to you, Daniel.
Thank you. Thank you very much, Amitava, and thank you also to our participants for continued good participation. I can see quite a number of questions coming through. Indeed, Amitava, that's a very comprehensive system. I know perhaps we do not have all the time to go into the details, but to our dear participants, should you want us to discuss further about this solution, please feel free to reach out to any of us or your usual contacts within KPMG, and we'll be happy to have further discussions around this. Now, I'm seeing a number of questions. I think the first one there from John, I think in terms of the IFRS 9 presentation yesterday, yes, we will be sharing with you the recording for yesterday, John Mugerwa, so we'll share that. Welcome, Henry from Paramount Bank. From Samuel Ombati, thanks for the session. ILAAP is not yet a regulatory requirement in Kenya, but is being adopted as a best practice. I do know that our Thogo has responded to that. He'll perhaps have a bit more time to comment on that. But I want to join that with a question from Harrison. You may wish to highlight best practices regarding capital allocation, that is capital add on for pillar 2 risks, and share examples of some measurement metrics in use within the East Africa market. So Daniel Thogo, if you can answer that, even as you get to the next session.
Thank you very much.
Then there is another coup. Are there practical benchmarks for setting risk appetite? Just 1 minute, Togo. Are there practical benchmarks for setting risk appetite and capital buffers? Most banks' risk appetite for non-compliance to regulatory is usually zero. I believe Amitava will want to take the question from Peter Thuku. But before that, Daniel Thogo, carry on.
Thank you very much, Daniel. And just to reiterate with the discussion we have had with Samuel, that indeed most of the regulators and how they approach the Basel implementation is through a phased approach. And what central bank has done, it has prepared financial institutions through the adoption of Pillar 1 of Basel III. And it's looking at how can the institution be able to prepare themselves to compute the LCR to ensure that they have enough liquidity to support them for a period of 30 days without any external help. And then also to be able to plan themselves, how then can they be able to have the NSFR stable funding for a period of 1 year. And then that will be the building block, because then when you go now to Pillar 2, that is where we are saying that we are going to require institutions to have an ILAAP. If banks in Kenya are doing that, it is good. They are forward-looking, and it is a best practice to actually be proceeding, to be going ahead before the regulation comes in. To the question for Harrison, and this is a very good and a very insightful question. I'm very happy to see this. And this is with regard to, actually it's a very technical question, and possibly Harrison is for to tell the panelists or even the people in this particular call what is capital add-on. The capital add-on is that capital where you as an institution, you evaluate your capital in pillar 1. The regulator has told you you have to have 8% of the core capital, but then you have evaluated and you have decided that that capital is not sufficient because there are other risks that I have not sufficiently covered under pillar 1. And I'll give an example that you have been able to compute your risk weighted asset for credit risk, and you have been able to come up with the capital charge. But then you also say, I have not been able to capture other nuances with regards to credit risk, and this is something like the concentration risk. And you want to go and dig and evaluate if, for example, my credit portfolio is concentrated in this particular sector, then how do I be able to ensure that I come up with capital to ensure that I protect myself against that? If then you are so much concentrated to a particular group of borrowers, maybe let's say you can be able to find that you are so much concentrated to the top 20 or even the top 50 borrowers in the institution. How then do you go and ensure that at least you're able to do a capital charge for that? To give an example of other risks that where you can be able to do this capital add-on, you're talking things to do with concentration risk, like I've mentioned. You're talking things to do with operational risk. You're talking about the RABB, that is the interest rate risk in the banking book. But then to narrow down into what you have asked, what are the sum of the methodologies that you can be able actually to use? And even what are the kind of the metrics in practice? Most of the institution, and especially concentration risk, we're talking about the HHI index. We're talking about, when you're talking about the IRBB risk, you're talking about the economic value of equity. And these are some of the journey that actually have been able to work in practice with some of our clients. And in the East African is that Kenya and Uganda and Tanzania, mostly they are aligned in this particular area. And these are the languages that you'll find even in the ICAAP and even in the regulatory guidance given out there. So to be able to narrow to sum that up is that we are saying that the best practice and the best approach, and from what you have been able to understand in the industry, is to make pillar 2 capital allocation quantitative where data allows as a best practice. But then you make it qualitative but evidence-based where data is not available. And this is where the supervisors in the East African are converging towards a particular hybrid model, where blending stress testing outcomes with expert judgment and, of course, governance overlays to define institutional specific capital buffers that truly reflect your risk profile. Let me go back to Amitava so that at least you can be able to address the query that has come from Peter Thuku with regard to the risk appetite. Back to you, Amitava.
Yeah, indeed. And as Amitava goes through this, the question from Peter Thuku, there is also another one from Henry Thumbi. How can banks compute additional capital add on with regard to sovereign or country risk? So Amitava, if you can take these two questions, please.
Sure. Thank you. So the first question, Peter, thank you for the question. Basically, you're asking how do we identify practical benchmarks for setting risk appetite and capital buffers. Most banks' risk appetite for non-compliance to regulatory requirements is 0, which is correct. You cannot have any sort of numbers associated with non-compliance to regulatory requirements. Almost every client, every bank where we have worked, it is almost always kept at 0. Which sometimes may be impractical, but that's the reality. You cannot have anything more than 0 assigned to a risk appetite for compliance requirement. However, for the benchmarks for setting risk appetite for others, basically when it comes to the red zone, which is the basic zone, it is always the regulatory capital the regulatory requirements. So if it is 4.5%, 5%, 9%, whatever it is, that is the basic benchmark. And then for the yellow zone, typically banks keep around 2 to 2.5% as a spread, so that at least, before you breach the capital buffers, there is a very strong a warning from the bank internally that you are almost reaching to breaching these buffers. So definitely around 2.5% spread, which we have generally seen, which banks tend to keep, so that they are not breaching any of the regulatory limits. I hope I've been able to respond to your question, but yeah, happy to have a more detailed conversation with you, so that we can respond to your requirements. The second one is also quite an interesting one. How can banks compute additional capital add-on with regard to sovereign or country risk? Typically, what we have seen is, the banks typically have an internal credit rating models for country risk or sovereign risk. It's difficult to develop a model because defaults, the count of defaults for risk are very less for a country or a sovereign. However, we have seen that S&P, Moody's, they do have various country ratings. We typically tend to calibrate our scorecard so that it almost matches to the S&P, Moody's credit ratings. And based on the credit ratings, they have given those percentages, the risk weighted, in terms of like if it is AAA, then it is 0%. Basel mentions 0.05. For your for a double A, it is 20% risk weight. Triple B is 50% risk weight. So you can assign some sort of risk weight based on the credit, internal or external credit rating of the country or the sovereign. Or if you have migrated to IRB approach, where you don't have a risk weight, you typically assign PD and LGD based on a historical data or based on expert judgment. You can arrive at some sort of PD LGD and then use capital requirement based on the IRB formula approach. So these are the two typical things which we have seen. Of course, there are multiple banks who also apply some capital risk add-on factors based on certain expert judgment factors. For example, they do consider factors like political instability, legal and regulatory environment within the country, the corruption levels, economic volatility. So we have a lot of reports from IMF, World Bank, which provides these matrices or indices to ensure that you are able to quantify the risk associated with the sovereign in a more scientific manner. So I would say these are the 3-4 things which I've seen in the market. Henry.
Thank you, Amitava. Thank you, Daniel Thogo, for those responses. And I do believe if you need further clarification, still feel free to type this up and feel free to engage the KPMG team even after this. I'll very quickly pass over to Thogo just to wrap up in terms of what next and the call to action. Kennedy Ochieng, Christine Jero, yes, we've taken note. We'll be able to share the presentation with the participants. Over to you, Thogo, for the next 2 or so minutes, just to wrap this up, then back to me.
Yeah, thank you very much. And interesting is that the question that came from Peter is that most of the time, where you find the board has stopped when they have said the risk appetite, we have zero appetite. Then that particular discussion when the board meeting ends and that particular document is left and has been approved, it becomes a fight in the bank because the appetite is zero. But how do we quantify that zero? Or we have no appetite. How do you quantify no appetite and put it in a formula or even in a solution? So the issue is then about how do you allocate that particular capital inclined and actually being able to be linked with the risk drivers. If you have zero appetite for reputational, go and look at what are the risk drivers for reputation. Is it in terms of the number of frauds? Is it in terms of the attrition? Is it in terms of the system downtime? All those particular things to be able to look for proxies and to be able to have that. Then these are discussions that you can be able to have possibly further to be able to ensure that at least these matters are well appreciated even within your institutions. The call to action. So what is it that we are speaking about today? looking at the journey that we have covered, looking at the challenges that we have been able to, to encounter. And of course, mentioning about the successes that we have been able to, to do a lot. The people in this, in this call back into institutions, you have invested in training, but then how then do we finish strongly in this particular process? We are saying that it is very important that the ICAAP process becomes easier, the ILAAP processes becomes easier, that instead of doing an ICAAP process in 2 or 3 months, this is a process that needs to be harmonized, to speak, to integrate all the things that you're talking about. We integrate the ARMF, we're integrating the risk appetite, we're integrating the stress testing, we're integrating all the kind of feedback we're getting from data. And what we are saying is that it does not need now to be done by 100 people, by 50 people. One person, a champion in ICAAP, can be able to do all this. All they need is to get the feedback and to get the data and to get the necessary insights to feed in that particular into this particular tool or the solution that we're having. And what is the importance? And that is one, we integrate and align all these particular frameworks. The other one is in terms of we need to automate to strengthen these particular insights. And what you're saying is that if you look at the embedded scenario designs there, now you will not even stop following up with who has not given you which particular data. And what you'll be doing is in terms of ensuring that you become more curious in terms of what are the kind of the scenario designs, what are the kind of the transition matrix or the transition mechanism from the macro even to the idiosyncratic issues, or that are specific to us as a bank. And then, of course, building capacity. How then are we being able to build the capacity internally from our own data, and then the kind of the insight that we're getting, and even to what value does a board derive from this particular output. So how can we help? This is a journey, and I know various institutions, they're at various places in terms of their maturity, in terms of what are the kind of the things that in all the process that we have talked about, even as we are now rolling out the ILAAP, is in terms of the automation and the data analytics. What data do you have, and how are you using that particular data to be able to present this particular ICAAP report out well? In terms of the interlinkage between the ICAAP and the risk frameworks that you're having, in terms of the appetites that have been set, if they are qualitative, how then do you do in ensure that they are quantitative? In terms of the stress testing and those particular scenario designs, how then do we embed them into your processes internally as an institution? And finally is that, how then do we speak in one language? Even as a board discusses these particular documents before you submit them to the regulator, how then do we draw the insight for them ARMF? How then do you even use this particular process to go back and even update as a feedback mechanism the ARMF of the institution? If it is in terms of the process of designing the appetites, how then do you use this particular process to inform your ICAAP process, and also use the ICAAP process to be able to give the feedback to the institution? And then in terms of the strategy, and more importantly is that Uganda and Tanzania right now, they are specifically requiring institutions to come up with recovery plans. The Central Bank of Kenya has not yet come up with a specific requirement for institutions to have a recovery plan. But I know right now they are reviewing the prudential guideline, and some of these nuances and insights are the possible kind of the outcomes we may end up getting from that particular exercise. So the recovery plans, the continuity plans, the BCMs, they sit at the heart of this particular input that you're getting from the ICAAP process. So I want to thank you very much, all of you, for those particular insights and those particular questions you have asked. And I wish to give it back to you, Daniel. Thank you.
Thank you. Thank you very much. My name is Daniel. And to the participants, I see we are just about top of the hour. I think from my end is to thank you all for being part of today's session on ICAAP and ILAAP automation. I do believe that the discussion has been insightful. Definitely, we showed you how automation is redefining capital and liquidity adequacy assessment and across our institutions. So from me, as we continue this journey of connecting strategy, risk, and performance, I would like to invite all of us to tomorrow's webinar. It's a series 3. Is that one we are having? Is going to focus on RAROC. I know Amitav has talked about RAROC in his solution, in our solution. RAROC is the risk-adjusted return on capital. So in that session, we will explore how profitability today must balance growth as well as risk, and how RAROC provides that bridge is some of the things that we look forward to unpacking is price loans with a risk-based precision, how to optimize capital allocation, identifying high value business segments, and enhancing our overall portfolio profitability. So please do join us same time tomorrow, 10:30 Kenya time. There is also a poll. Sorry, there I forgot to mention that there is a poll there that please give us your feedback. It's projected there on the screen. You can give us your feedback. I just want to thank you so much for your time as you fill up this. Allow me to just invite our partner from Business Consulting Services to just make a minute closing remark and on this. So Bernard Amuka, you can just make a closing remark as we fill up the questionnaire. Thank you.
Indeed, Daniel. Thank you very much, participants, for joining. As has been mentioned, we remain on standby to partner with you, team up, and engage with yourselves in everything that you do. So Daniel, to you, thank you for making the session lively. Back to you.
Thank you very much. Please stay on in case you've not finished the questionnaire. I would like to thank you so much. Please give us that feedback. Take a minute. We'll have another 2 minutes. But for those who have already completed, thank you very, very much for being part of this. And hopefully, looking forward to seeing you tomorrow. Feel free to share this with your other colleagues that would want to learn more about RAROC tomorrow. Thank you and have a good day. Good afternoon.
Thank you. Have a good day. Bye-bye.